Raising Private Capital, PPM, Term Sheet, and Due Diligence by Julia Pleinamar. Companies can raise capital with an IPO, meaning that the company will be a public company, or with a private placement. There are two forms of private placement a company or an entrepreneur can take advantage of: a private placement memorandum or a term sheet. While discussing and negotiating a business transaction, it is necessary that the parties, especially the investor, proceed with some degree of research and gather enough information that they judge necessary and relevant. This practice is called due diligence and is also part of a private capital placement. Private Placement Memorandum Overview. The PPM is a document created to offer securities to possible investors in exchange for capital. The securities are offered to only a small number of investors, which make it possible to business to target specific investors that they think would be willing to proceed with a transaction. The main purpose of a PPM is to disclose information to the investors about the nature and the risk of the investment they are about to engage in. This protects the issuer from possible fraud claims in case the investment goes sour and does not turn out the way it was planned. The format of a PPM. There are some common aspects to every PPM. First, there is a section called the summary. This details the specific terms of the investment. Also, the legal disclaimer explains the specifics of how the private placement will take place. The section on risks explains the specifics and generic risks associated with the business. The charts show how the business is capitalized and the dilution of stock that the capital raising will cause. Lastly, there is a subscription agreement, that is the contract that must be signed in order to move forward with the agreement. Because the PPM provides a vast description of the business, it is often thought to be the same thing as a company's business plan. However, even though there is an overlap, the two are not the same thing. The business plans go into much more depth on the market research, objective, tactics, and the strategic future position of the firm. The PPM, on the other hand, mainly focuses on the analysis of risk that the business faces and disclosure of that information to the investors. A business plan cannot have an offer on it, while this is the primary purpose of a PPM. Often, a business plan is included in the PPM as an exhibit to provide further information for the investor. The regulations regarding PPM. A private placement is the selling of securities that not have to be registered with the Securities and Exchange Commission. However, for this to happen, the issuance needs to conform to an exemption section provided by the Securities Act of 1933. The PPM has to be written specifically to comply with one of the exemptions. It explains exactly how the offering complies with the exception section. Most private placements are offered under the Regulation D. The PPM has to contain a description of the security and the terms of the sale. Also, it has to contain a section describing the issuer's financial situation and all the possible risks. Besides Regulation D, other regulations that may apply to private placements are Rule 144A and Regulation S. Rule 144A states that an offering can only be sold to qualified institutional buyers. These institutions manage over $1 billion in assets. The offerings usually are for convertible bonds or convertible equity. Regulation S allows for the private offering to foreign investors. Term sheets. The second form of private placement possible is through the use of a term sheet. This is a generic document that goes over the most important aspects of the deal without going into many details. Therefore, the term sheet is much less detailed than a PPM. The term sheet goes over briefly the major aspects of the business transaction in order to ensure all parties are in agreement with the major details, reducing the chances of misunderstanding. The term sheet sets the basis for a negotiation between entrepreneurs and venture capitalists. Differently than a PPM, the venture capitalist is the one required to prepare the document. Usually, the investors will prepare the document in order to protect themselves and get the most possible return. The term sheet is a conditional offer. Investors and entrepreneurs will discuss and negotiate further details based on the first document. Because of these characteristics, the term sheets are known as a non-binding document, basically setting the basic terms and conditions under which the investment will be made. It is a template to develop a more detailed legal document after all negotiations have been made, and after the parties have finally reached an agreement, a binding contract is drawn. The major benefit a term sheet provides is that it is a leverage instrument to the entrepreneur. Usually, entrepreneurs will get more than one offer for an investment. Having a term sheet done by one investor shows other possible investors that there are people interested in the company. This will likely increase the interest of other venture capitalists. It gives them the sense that the investment might be worth it, since other investors already took the time to do research regarding the investment in order to prepare a term sheet. Now, many investors are interested in the investment, and the entrepreneur has more choices to compare and choose from. The term sheet format. An effective term sheet should include some important descriptions. It should include a definition of total investment amount and if the payment will be made in one whole amount or in various installments. It also should include a definition of what type of stock is being negotiated, if it's a common stock, a preferred stock, or a participating preferred stock. It also has to have an explanation of the pre-money valuation. This is a company's valuation before the new investment is made, and it's used to determine how much equity to demand in return for the cash injection. Also, it has to define the future ownership of the investment. This is calculating by dividing the amount of the investment by the valuation after the cash injection. Also, it has to have an analysis of the future management and board of directors, as far as how many seats the board will have, who the next CEO will be, and so on. Lastly, it has to determine the distribution of the firm in case of bankruptcy. It determines if the investor gets 100% back of the investment or more. Lastly, there is due diligence. Before any of the methods explained before are prepared, an investor should perform what is called a finance due diligence. This is what is called in colloquial terms doing the homework. It is the basic process of researching the opportunities, positive and negative aspects of the transaction. It is an investigation of the business prior to signing a business contract. It analyzes all aspects involved in making the decision. It should confirm that the business is exactly what it seems to be and there is no hidden schemes. The process of due diligence should start when the opportunity of an investment is first identified and carry on throughout the whole negotiation process. One of the most important due diligence in the world of private placement is a financial due diligence. This is an explanation by the entrepreneur of how the funds will be used, how the budget and the business model will be developed, and a legal review of the business. There is a different number of due diligence that overlap with the financial investigation. The commercial due diligence compares future business plans and revenues with the industry trends. The technical and operation due diligence tests the cost assumptions made for the future business. The HR due diligence analyzes the financial aspects related to the employees' matters and how these costs affect profitability. Lastly, the legal due diligence assesses hidden legal issues regarding associates and stakeholders.